Welcome to the deep dive. Today we're looking into three really significant news developments.
That's right.
First, the major disruptions at Newark Airport. Then, how online shopping is changing because of new tariff policies, focusing on Temu.
And finally, the U.S. economy and where the stock market's been heading lately.
Exactly. Our goal here is to unpack these, give you the context you need, and sort of see how they might actually be connected.
Yeah, they're definitely complex issues, each with, pretty big implications. Hopefully, by looking at the facts, the drivers behind them, we can get a clearer picture.
Okay, let's start with Newark Airport. We're hearing about substantial flight disruptions. What's the core situation there?
Well, the main thing seems to be the air traffic control system is really under strain. United Airlines, for example, they've announced they're cutting 35 daily round-trip flights.
Wow, 35 a day.
Yeah, starting this weekend. And their CEO, Scott Kirby, he wrote a letter basically saying it's because of FAA equipment problems and, crucially, air traffic controllers' staffing shortages. They just couldn't keep up their schedule.
Okay, and has the FAA confirmed these reasons? Are they seeing the same thing?
They have, yes. The FAA acknowledged some technical glitches at the Philadelphia Tracon Center that affects Newark's airspace, and they also admit that staffing shortages are, well, a contributing factor.
Right.
Plus, there were those reports you might have seen about controllers walking off the job after some equipment issues on Monday.
Yes, the walk-offs. There seem to be different stories about what actually happened there. What's the main point of disagreement?
Well, the FAA said it was a brief telecom line issue, less than 2 minutes impacting monitoring systems.
Less than 2 minutes. Okay.
But United CEO Kirby, he stated that over 20% of Newark's controllers actually left their posts after these outages.
20%. That's a significant difference in perspective.
It really is. It sort of highlights how severe the airlines feel these disruptions are operationally speaking. What does that gap tell us about the pressure in the system?
Well, the sheer number of delays and cancellations recently certainly suggests a system that's struggling. Can you give us some hard numbers on that?
Sure. So looking at recent data, Friday saw 177 delays. That's 34% of flights. Thursday was even worse, 242 delays, impacting 44% of the schedule.
44%.
And United had to divert at least 35 flights on Monday just because of FAA-mandated traffic slowdowns. So, yeah, the impact is pretty significant for travelers and the airport.
And then there's the runway construction layered on top of this. How does closing runway 4L22R play into it?
Right, that's another factor. Closing that runway, which is a major one for departures for rehab until mid-June, just cuts the airport's overall capacity.
It's the busiest one for takeoffs, I read.
Exactly. So having it offline definitely worsens congestion and adds to the delays we're seeing. It's needed work last done in 2014, but the timing, well, it couldn't be worse with these ATC issues.
It's interesting, too, that United has been pushing for slot constraints at Newark like they have at LaGuardia and Reagan National. Why do they want that?
Yeah, that's been their position for a while. They argue Newark's chronic congestion needs better management, basically limiting the number of takeoffs and landings per hour.
To make it more predictable.
Precisely. More predictable flow, fewer delays. They even cut their schedule temporarily back in summer 2023 for similar reasons, so it shows their ongoing concern about Newark's capacity.
And this nationwide shortage of air traffic controllers, that seems like a really central piece of the puzzle. How bad is the shortfall?
It's significant.
Yeah.
The FAA is about 3,500 controllers short of their target nationally.
3,500.
Yeah, which means mandatory overtime. 6-day weeks for many controllers. It puts a huge strain on the workforce. You see the FAA extending slot waivers at New York airports through late 2025. That's basically admitting it's going to take time to fix the staffing.
And we're expecting the Transportation Secretary, Sean Duffy, to announce some measures soon. What might be on the table?
We are. The announcement's expected next week, likely focusing on revamping airport infrastructure equipment. The FAA is also trying financial incentives to get more controllers.
But fixing the staffing isn't quick.
Not at all. It's quite telling that the FAA projects the New York facility, the one covering Newark, won't even hit 70% of its target staffing until the end of 2026.
End of 2026. Wow. What does that timeline suggest about how hard this is to fix?
It suggests it's incredibly complex. The FAA points to a few things.
Like what?
Well, COVID-19 disruptions definitely interrupted training pipelines. Plus, the training itself is long and very demanding. And then there's just normal attrition, people retiring or leaving.
So a perfect storm, almost.
Kind of. They say they've been exceeding hiring goals recently and plan to speed it up, but catching up from that kind of deficit takes time.
So United pulling back 10% of its flights feels like maybe a strong message.
I think you could read it that way, yeah. It seems like a clear signal to Secretary Duffy and the FAA about needing to speed up ATC modernization.
Especially with that big next-gen overhaul being so delayed.
Exactly. That $5 billion next-gen system is 8 years behind schedule. This move by United really underscores their frustration with those delays and the real-world impact on operations. It does raise questions about oversight on these huge projects.
Okay, let's shift gears now. We need to talk about online shopping, specifically Traiffs and the retailer Temu. What's the big change that's happened?
The key thing is Temu has stopped shipping directly from China to the U.S.
Stopped completely.
For direct-to-consumer orders, yes. This is a direct result of the Trump administration getting rid of the de minimis rule exemption, but specifically for goods coming from China. That kicked in May 2nd, 2025.
Okay, maybe quickly explain that de minimis rule for people who aren't familiar. What did it do?
Sure. So de minimis goes way back. Tariff Act of 1930. The idea was to make trade smoother by letting low-value shipments, think small packages, come into the country without tariffs or lots of customs hassle.
And the limit was $800.
Right, since 2015, it was $800. That meant a lot of low-cost stuff, especially from e-commerce sites like Temu or Shein, could come in duty-free. But then concerns grew that these big Chinese platforms were, well, maybe exploiting it to dodge tariffs.
And what was the administration's official reason for scrapping it just for China and Hong Kong?
They gave a couple of reasons. One was concern about deceptive shipping practices. Another was worries about illicit stuff, like fentanyl precursors, potentially coming in through these small packages. And then there was the argument that it just wasn't fair, that it gave these Chinese platforms a big advantage over American retailers who did have to pay tariffs.
So with that exemption gone for China, what tariffs do these goods face now?
It's pretty steep. Goods that used to be duty-free under de minimis now face either 30% of their value or a flat $25 fee per item, whichever is higher.
$25 per item? That could be huge on cheap stuff.
Exactly. And that flat fee goes up to $50 after June 1st, 2025. Some experts are estimating the effective tax rate could hit 145%, or you pay that flat fee, depending on the item's value. It replaces any existing tariffs, too.
So how is Temu responding? What's their new plan?
They're pivoting. They're moving to what they call a local fulfillment model. So U.S. customers will buy from U.S.-based sellers on their platform, and the goods will ship from warehouses inside the U.S.
So they're trying to build a U.S. marketplace.
Essentially, yes.
Yeah.
They're actively recruiting U.S. sellers now. Now, Temu claims prices won't change for consumers.
But analysts are skeptical.
Analysts are definitely suggesting those ultra-low prices will probably have to go up. Temu had already started raising some prices and adding import charges even before this fully hit.
Right.
You have to wonder, what are the logistical hurdles for them? I mean, scaling up a whole U.S.-based operation that fast.
Yeah, that seems challenging. What about the bigger picture? What does this mean for us, the consumers, and for trade generally?
Well, for consumers, it likely means saying goodbye to those rock-bottom prices on goods shipped directly from China via platforms like Temu.
The bargain basement days are over.
Potentially, for that specific channel, yes. For trade, we might see demand drop for some Chinese goods because they just got more expensive. And it's worth noting, this is expected to hit lower-income households harder.
How so?
Apparently, studies showed nearly half of these de minimis shipments were going to the poorest zip codes in the country.
Interesting. And what about the administrative side? Customs, importers?
Yeah, that's another layer. U.S. Customs and Border Protection, CBP, now has way more low-value packages to potentially inspect and process. That can mean delays.
More paperwork, more checks.
Right. CBP is actually suspending some of the simpler mail entry rules now, requiring formal entry processes for mail over $800 from China or Hong Kong, and probably putting more scrutiny on the lower value ones, too.
Now, some argue this will actually help U.S. manufacturers compete. What's that argument?
The idea is that closing this loophole levels the playing field. U.S. companies couldn't compete with duty-free imports on price alone.
So removing that advantage helps them.
That's the claim. Industry groups, especially textiles, have been vocal about this. They say the loophole hurt them badly, and this policy change gives them a fighting chance against what they see as unfairly cheap imports.
But the reaction hasn't been universally positive, right? What are the different takes?
Definitely mixed. China's foreign ministry, unsurprisingly, criticized the policy and wants it reversed.
Okay.
But here in the U.S., many lawmakers and officials are defending it, saying it's vital for stopping illegal goods and protecting American businesses. It really highlights those ongoing trade tensions and the impact of these kinds of policy moves.
Okay, let's move on to the broader U.S. economy and the stock market. We saw a bit of a roller coaster, especially with these tariffs involved, but then a rebound.
Indeed. Wall Street had a significant comeback in early May. It seemed to claw back a lot of the losses that came right after President Trump's tariff policies were announced.
How strong was the rebound?
Pretty strong. The S&P 500 had its longest winning streak since back in November 2004, 9 straight days of gains. It basically wiped out the losses from that April 2nd Liberation Day tariff news.
And the Dow and NASDAQ, too.
Yep, similar story. The Dow Jones also had a 9-day streak, its first since December 2023, and the NASDAQ jumped about 1.6%, putting its rebound from the April lows near 18%. That's getting close to, official bull market territory.
What fueled this sudden optimism? What drove the rally?
A couple of main things, it seems. First, the April jobs report came in better than expected. 177,000 jobs added versus a forecast of about 135,000.
Okay, positive economic data.
Right. And second, there was renewed hope about U.S.-China trade talks maybe restarting. China signaled they were willing to actually look at U.S. proposals. That seemed to really boost investor mood.
But we should remember April itself was pretty rough for the markets, especially after those tariffs hit.
Absolutely. That context is crucial. Despite the May rally, both the S&P and the Dow ended April down. That was the third straight month of losses for them. The NASDAQ managed a small gain.
And that initial reaction to the April 2nd tariffs was sharp.
Very sharp. The S&P 500 dropped over 12% between April 2nd and 8th. Some called it the biggest global market drop since the 2020 crash. So the recovery we saw in May was quite significant against that backdrop.
Did strong company earnings play a part in the rebound, too?
They definitely helped. We saw some really solid earnings reports, especially from big tech companies.
Like who?
Meta and Microsoft, for instance. They reported strong numbers, talking about big investments in AI, and their stocks climbed. That suggests that even with broader economic worries, parts of the market are still performing well.
But despite this recent rally, are those underlying worries about tariffs and maybe a recession still there?
Oh, absolutely.
Yeah.
The optimism is there, but the anxiety hasn't vanished. Concerns about the long-term hit from tariffs, the risk of a recession, those are still very much present.
So forecasts are still cautious.
Some Wall Street firms have tweaked their year-end targets, reflecting that uncertainty. Most analysts still seem to expect a recovery by the end of 2025, but, the risks haven't gone away.
And that news about China evaluating U.S. proposals for trade talks, how significant is that statement?
It's pretty notable. It's the first time since these big tariffs went on that China has publicly said they're actually looking at U.S. proposals.
A potential opening.
It suggests at least a potential shift, yeah. Maybe a path to de-escalate tensions. And the market certainly seemed to like the sound of that.
Let's go back to that April jobs report. 177,000 jobs added. What else did it show? Which sectors were hiring?
Right, so 177K added, better than forecast, but a little less than March's revised 185K. Unemployment held steady at 4.2%.
Okay.
Sector-wise, gains were seen in hospitals, restaurants. Interestingly, transportation and warehousing saw a big jump, plus 29,000 jobs.
Why was that?
Some analysts think that was companies rushing imports in before the tariffs really bit hard.
Okay. Makes sense.
We also saw gains in finance, social assistance, government, construction, and leisure and hospitality, mostly restaurants and bars there. Manufacturing, though, actually lost about 1,000 jobs.
And what were some of the broader economic signs or expert takes around this report?
Well, some saw it as, reassuringly normal, but concerns linger about businesses maybe pulling back on hiring and spending and consumers being cautious.
Because of the tariffs.
Yeah, forecasts suggest tariffs could hurt jobs, especially manufacturing, due to higher costs and retaliation. One economist, Anirban Basu, pointed out that the April data probably doesn't fully reflect the tariff impact yet. The timing might be off.
I see.
Meanwhile, President Trump called for Fed rate cuts again after the numbers, but the Fed's likely to wait and see how the tariffs play out given the potential inflation risk.
Okay, one last major topic. The Justice Department versus Google, specifically over digital advertising. It sounds like the DOJ is really pushing hard now.
They are, yes. The DOJ is formally asking a federal judge to force Google to sell off key parts of its ad tech business.
This follows a court ruling.
Right. A judge already ruled that Google illegally monopolized parts of the online ad market. So now the DOJ is pushing for the remedy phase.
And what exactly does the DOJ want Google to sell? Which parts?
They're targeting two main things: Google's publisher ad server, that's the tool websites use to manage ad space, and its ad exchange, which is the big auction house for buying and selling display ads.
How would that work?
They proposed a phased approach. Start by making Google share real-time bidding data from its exchange with competitors, then move to full divestiture. They had a deadline earlier this month for proposals, and there's a hearing set for September.
What was the core argument the DOJ made that led to the monopoly ruling in the first place?
Well, the trial was back in September 2024. The DOJ argued that over, 15 years, Google used acquisitions and rigged its ad auctions to build and maintain dominance.
Rigged auctions.
That was the allegation. They argued Google controlled the whole ad tech stack, hurting publishers who rely on ad revenue, hurting advertisers, and ultimately harming competition and consumers who get free content supported by ads. They focused particularly on Google's control over selling banner ads.
And how is Google defending itself against this breakup demand?
Google's fighting it hard. They're saying the divestitures the DOJ wants are 1, unworkable, 2, incredibly disruptive to the whole industry, and 3, just not legally justified by the judge's actual findings.
They think it goes too far.
Way too far, in their view. They argue their tools work together and offer value. Google has admitted some trust issues came up in the trial, and they seem willing to accept some kind of monitoring to prove they're sticking to any promises, but they say a breakup is just unnecessary and damaging.
Now, the judge, Judge Brinkema, she apparently had some doubts about selling everything the DOJ wanted, particularly the ad server.
She did express some skepticism, yeah.
Yeah.
Especially about selling the ad server, which Google got when they bought DoubleClick way back in 2008. She wondered if maybe just selling the ad exchange and forcing data sharing might be enough.
But she still had concerns about Google's impact.
Oh, definitely. She was clear that she thought Google's policies weren't in publishers' best interests and did harm competition and users. She actually urged both sides to try mediation to find a solution.
And this whole fight is happening while big tech generally is under more scrutiny, right?
This isn't happening in a vacuum. The DOJ has that other big case against Google over search dominance. They even suggested Google might have to sell Chrome in that one.
Wow.
Yeah. And there was another ruling back in August 2024 against Google's search and ad monopoly. Regulators are also thinking about how to stop dominant companies using things like AI to get even more entrenched.
So if Google is forced to break up its ad tech, what happens then? What are the potential impacts?
It could be huge, really far-reaching consequences for digital advertising. Some publishers are actually eager for change, hoping it leads to a fairer market, maybe more revenue for them.
But others are worried.
Others worry about disrupting the whole system they rely on for programmatic ads. Some experts think a breakup could actually spark innovation, let new independent players emerge.
So it could fundamentally change things.
It really could. It could change how publishers fund their content, how advertisers reach people, and even how you, the consumer, access information online, since so much of it is ad-supported.
We've certainly covered a lot today. From the chaos at Newark Airport and the shifts in online retail driven by trade policy, right through to the economy's ups and downs in this major regulatory battle in tech.
Yeah, and what's striking is how interconnected they feel, even if they seem separate. They really highlight this complex dance between, physical infrastructure like airports, global trade rules, and the digital regulations shaping our world.
The Newark situation really underscores how vital that underlying infrastructure is.
Totally. And the Temu story shows how quickly trade policy can ripple through global e-commerce. Then you have the markets reacting to all this, plus the government trying to grapple with the power of big tech like Google. It's all linked.
So as we wrap up this deep dive, here's something to think about. How might these ongoing shifts in global trade, in digital advertising, the reliability of our basic infrastructure, how might they all combine to shape the information you get, the products you buy in the coming years?
And maybe, what does all this mean for longer-term economic stability and growth? It's a lot to consider.